Hi and welcome to this week's Property Insider video. Being the beginning of the month, we take a deeper dive into the property data with Dr. Andrew Wilson, and then we take a look at some of the stories making the news recently. We look at the International Monetary Fund's latest forecast for the world economy and Australia's economy, and there's some good news there. And we look at those headlines suggesting that with another wave of coronavirus in Victoria, property values could drop 30%. We have a bit of a look at what's happening to unemployment and consumer confidence. So at the end of this, you're going to have a better understanding of what's going on in the property markets. If you'd like to keep up to date with our regular Property Insiders videos, why not subscribe to this channel now by hitting the subscribe button? If you want to be kept up to date even more frequently, just click the little bell icon so YouTube keeps you informed. Well, we're halfway through the year, and what a 6 months it's been. No one started 2020 thinking we'd have a triple whammy of a world pandemic, slipping into a recession, and experiencing so much social unrest. And while all those matters have been making the headlines over the last month, our property markets have shown remarkable resilience. So today, in our more in-depth beginning of the month Property Insiders chat, Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market, will bring us a detailed look into what's happening in property around Australia. Welcome, Andrew.
Thank you very much, Michael, and Happy New Year.
Yes, the beginning of a different sort of new year. You're right.
Yeah.
There's been a number of interesting news items this month that I want to chat with you about, including the International Monetary Fund's economic forecasts for Australia, which were positive, what's happening to unemployment, and some wild claims that a second wave of coronavirus in Melbourne is going to cause prices to crash 30%. Yeah, they're back again. I'd first of all like to get on to what's actually really happening, evidence-based information rather than speculation, Andrew. So far it seems that COVID's impact on our housing market's been milder than many anticipated.
Well, that's true, Michael, and we're all in unknown territory, of course, when the shutdown was at its deepest. I think the markets have certainly taken advantage of what's been a reasonably shallow shutdown of 2 months. We did start to get early signs that the shutdown would ease. That worked its way into consumer confidence, and that kept what was a reasonably steady housing market ticking over. And we're now seeing increased numbers of sales and listings coming into the marketplace. And we can be pretty well pleased that once again, Australia's housing markets have performed in a resilient manner.
One of the good things, of course, is despite the new listings, the sales have kept up with that, if in fact been a little bit better. So let's get into it. Before we get into the deeper monthly data to see what's gone on, what's happened over the last week, Andrew?
We look over the last week, Mike. Of course, we had our auction results as usual on Saturday. Auction activity has remained quite steady. In fact, auction numbers are now tracking higher than where they were a year ago, Michael, which is quite interesting. Melbourne and Sydney we're talking about particularly here. The smaller capital city markets of Brisbane, Adelaide and Canberra are still a little skinny on the ground for auction numbers, but there's no doubt that Melbourne and Sydney auction numbers are certainly on the rise, and over 500 listings in each of those capitals on the weekend. I do think, however, a lot of that is now inflated by the new online auction marketing techniques. We're not quite sure how that's being reported. We're still seeing very high numbers of withdrawals. Withdrawals from auctions are now still double what they were at the same time last year. Now, whether this reflects the nature of online auctions, where the withdrawal becomes not as big an issue as in a traditional auction sense, but nonetheless, we need to take perhaps our auction results with a grain of salt in Melbourne and Sydney as a response to that. But nonetheless, clearance rates are now steadying around about 60% in Melbourne, a little bit higher in Sydney. That's a reasonable market environment. However, if we do look a little deeper into the results, we're probably still seeing a lack of higher priced properties coming into the market and selling. I think that's one of the weaker parts of the market is prestige property. No surprise given the nature of confidence and that we do have more discretionary activity at that end of the market. But also, of course, it is the middle of the year when we do typically see fewer higher priced properties. If we look at other activity, National New Listings Index has stabilised following the break for the Queen's Birthday holiday, now starting to rise. The latest data out today shows that the trend is now moving upwards and the index now lies over 80. 100 point was at the pre-coronavirus point. If we look also at the relationship between each of the capital cities in terms of new listings, Melbourne still leads the pack. Melbourne was down a little bit in terms of new listings over the last week. Sydney and Brisbane increased. Perhaps we've got to look now a bit more carefully at Melbourne in terms of new issues regarding the coronavirus in that city that may dampen some of the confidence of prospective sellers in the market. So we'll keep an eye on that. If we look at new seller activity compared to the same time last year, it's still tracking higher than a year ago, Michael. So again, another sign that markets are quite stable, and that underlying stability again reflects reasonable levels of confidence from sellers. Buyer numbers are starting to rise. Of course, we're seeing higher numbers of auctions now in the market, and that means more auction sales. We've seen drops in private treaty activity in Melbourne and Sydney, but that's picked up with higher levels of sales from auctions. So sales activity eased slightly over the last week, but trend on the rise. And interestingly, Michael, I have a measure where we put the new sales and new listings data together, and that capital city by capital city basis. And that shows us just a measure of competition in the market, and that's the number of listings per buyer. And we can see that Adelaide and Sydney have the lowest level of listings per buyer, so that means fewer choices for buyers, and Melbourne at the other end has higher levels. So that's an interesting measure of competition in the marketplace, Michael. Overall, for a midwinter market, this is given the issues over coronavirus shutdowns, which are now, of course, behind us everywhere except Victoria, we can be quite pleased at how resilient our housing markets continue to be.
Yes, and they'll have surprised some people who are predicting much bigger falls. An element of that, of course, is the support the government's giving tenants and landlords and homeowners. It's also related to the fact there aren't as many properties on the market, but there aren't the mortgagee sales that people were worried about, concerned about. Now, what's happening with asking prices?
Well, house values have been reasonably stable, as we always mention at this time of the month, Michael. The monthly figures can tend to be volatile, but we did see the Sydney market drop down over the month, prices down. Most other market up or down slightly. I think the Sydney market, as we discussed before, is lower prices reflect to some degree fewer higher priced properties in the marketplace. I think that's having an impact on the value of properties as measured on a month-to-month basis. We won't really see a revival in prestige property or higher priced properties, Michael, until the spring, as is usual every year. But if we look at units, not much movement there with units, down a little bit in Sydney in terms of prices, but overall certainly no signs of a significant change downwards in prices, and we can track that with the underlying trends, and other price models are reflecting the same outcomes, whereby prices are flat but certainly not showing any signs of a steep decline. And as I said, there are local factors in terms, or market level factors in terms of particularly prestige property, that are keeping prices steady at the moment, but we can certainly say that there's no sign of a sharp decrease in prices for units or houses evident over the coronavirus period so far.
Sure. So there isn't one Sydney property market or one Melbourne property market. We know certain segments of the market suffering a bit more, like new apartments and the off the plan and the house and land, and also recognise that, as you said, there isn't as many higher value properties being sold. So that's going to affect that as well. But the rental market seemed to be suffering a bit more, Andrew.
We're certainly starting to see some issues in the rental market, some disturbances. We saw some remarkable increases in vacancy rates for apartments. So most capital city markets reported an increase in the vacancy rate for units, for apartments, for rent, and our biggest increases were in Sydney and Melbourne. In Sydney now, we're pushing up towards 25,000 advertised for rent apartments, which is not just a record, but it's quite an extraordinary number. And no surprise, we've seen vacancy rates increase to 5.5% for units in Sydney, and overall vacancy rates are up to 4.1% now in Sydney. We saw a similar sharp increase in unit vacancy rates in Melbourne as well, Michael. And when we look closer at the data, it's really the inner suburban, inner city CBD markets where it's very difficult for landlords to find tenants for apartments. And I think this does reflect the impact of fewer international students that typically gravitate towards those inner city markets. In Sydney, postcode 2000, 1,000 listed vacant units at the moment, and other inner city areas such as Pyrmont and Zetland and Chippendale are all showing Waterloo is showing very high numbers and significant increases over the past year in the number of listings for units for rent. And we're also seeing downward pressure on rents as well in those areas, Michael. Rents have fallen by over 10% in most of those in Sydney suburbs. And again, this is going to prove problematic for landlords going forward, particularly those that are more highly geared. We must remember we had, particularly in Sydney, record numbers of investors particularly in 2015-16, and struggling to find a rental income may mean higher levels of stress sales later in the year, which we need to watch out for. Now, it is July the 1st, of course, as we've mentioned. Michael, happy new financial year, but it is a happy new year for those 10,000 first home buyers that now become eligible for the government's first home buyer deposit scheme. So if we do get more listings at the bottom end of the market from investors, those numbers of first home buyers eligible for the scheme will help to soak up some of that excess stock if it comes along. But certainly other factors that are acting to higher levels of inner suburban unit vacancies in Melbourne and Sydney are also Airbnb, holiday accommodation, still moving towards the permanent accommodation or into the permanent accommodation market, although some of that is easing now. But also a lack of movement from interstate moving into Sydney, and of course Melbourne means that demand for those inner suburban units is lower. But interestingly, Michael, when we look at the data, yes, we're seeing a surge in listings in vacancies for units, but we're actually seeing at the other end of the scale signs of a reduction in the number of houses that are advertised for rent.
Well, Andrew, the headline that shocked me in the Australian Financial Review this week, they again ran it. Victorian outbreak raises the chance of a 30% property fall again. Really? The underlying premise is the situation in Melbourne's reflecting that worst case scenario modelling that people were talking about, the second wave of coronavirus, high unemployment, restrictions remaining in place longer. But I can't see huge waves of forced sales. We know property values just aren't going to fall that much, Andrew.
Well, we keep going back to the modelers with their 30% negative predictions keep going back to the same well, don't they, Michael? Of course, it's an exciting headline. I'd really like to see the details of their methodology, how they come up with these numbers. And, really, I mean, to most that follow this, we know that they're consistently wrong. At this stage anyway, fingers crossed, we don't have the level of shutdown that we had in Melbourne 2 months ago. At the moment, it's restricted to certain suburban areas, as it's not across the board. So if anything, it's a less severe impediment to activity than we had during April and May. But certainly I'm not trivialising the significance of it, and it will have an impact on particularly seller sentiment. But it is, again, a limited part of the Melbourne market. And if we do see any downward movement in prices, which we have seen, but it's been marginal, it will, I believe, continue to be marginal going forward. But look, these are cheap headlines, Michael. We've seen them forever. They will continue.
Of course, the concerns about a second wave or coronavirus affecting the economy worst has definitely dampened consumer confidence. So only a day or two ago, the ANZ Bank Roy Morgan Weekly Consumer Confidence Index stopped rising. It's dropped a little bit. It's still way above the very low levels of April when we first got the shock, but there are still more pessimists than optimists around. So we've just got to see how it all pans out. But there's also good news, Andrew. If you look for it, the Reserve Bank has suggested our downturn is going to be severe, but the upturn's going to come pretty quickly. And recently, the International Monetary Fund brought out its latest forecast, painting a bleaker pandemic picture. But when you read further, you actually see that Australia is going to be a star performer. The International Monetary Fund downgraded its expectations of the world's economic performance, forecasting global economy would contract 4.9% this year in 2020. Previously, it thought it would only drop 3%. But then it believes next year the economy is going to pick up 5.5%. A bit less than what it thought a while ago. The International Monetary Fund has ruled out that V-shape economic recovery people are talking about, but that's in line with what we've been talking about for a while. We're suggesting a staircase type recovery without a full recovery to our economy until the international borders open. But the good news for Australia, Andrew, is that the International Monetary Fund expects our economy to only dropped by 4.5% in 2020, and that's better than the 6.7% contraction it forecast in April. And then it expects our economy to grow by 4% in 2021, which is huge compared to our more recent experience. And that's in line with the Reserve Bank's suggestion that our economy's picking up. In fact, there are already signs the economy's picking up, Andrew.
Well, that's right, Michael. And I think the other point we should make that we are in the good news, bad news cycle, and that does impact consumers, of course, and investors. But I think that we are a bit more relaxed about the nature of the coronavirus issue. I don't think it'll have as big an impact on sentiment as it did back in April and May when we really were in uncharted waters. I think people understand what can be done now to offset the spread of the virus. That's been successful so far, certainly in every state except Victoria, every capital city except Melbourne. And, the Queensland borders are now open from July 14th. So that's good news. It'll mean good news for Queenslanders in terms of their economy and tourism. And it's just another positive feel-good outcome for Australians generally, that they feel that they can now move around basically into most of the states. So again, we're going to have short-term shifts in sentiment as the coronavirus attracts headlines, as it has done down in Victoria, and rightly so. But I think we're becoming more resilient in terms of our activities as investors or consumers to those headlines going forward. And that's part of the reason why the outlook for the economy is better, because we're feeling better about the outlook as well. And we'll be getting on with the business of living and spending and consuming down the track. And I noticed that the latest employment data is showing a lot of people have returned to work. And perhaps the Prime Minister's got a point when he says that it has been, I guess, reasonably generous by previous standards, the income support packages through JobKeeper. And the point about maintaining that level of support is that it doesn't want to become a disincentive to go back to work. But we are seeing significant numbers of Australians going back to work now. And I think this is a process that will continue, but we need to keep a weather eye on what's happening in Melbourne for sure.
With regard to unemployment, a lot of those who did suffer, those in the hospitality industry, the service industries, the arts and entertainment, were in general the younger population too, and many of those were tenants as opposed to homeowners. And that's probably part of the reason why the rental market has suffered a little bit more than the owner-occupier home market, Andrew.
Yeah, absolutely, Michael. And we've got to understand that we're still seeing quite reasonable numbers of first home buyers active in the market. We always see this during times of lower activity from buyers generally, because first home buyers take advantage of those lower levels of competition to purchase their first home. It's a very strong motivating force in young Australians to own their own home. And now we have even more coming into the market, 10,000 places over this financial year. What it does mean is less demand for rental properties, because those first home buyers become first home owners rather than tenants.
Well, we'll have an interesting second half of 2020, and there is that Chinese curse saying, may you live in interesting times. Andrew, I hope they're not as interesting as the first half of this year. Thanks for your time.
Absolutely, Michael. Thank you.